Hi, I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. We're going with Simple is Better for the title of this November-December update because we believe that an elegant, efficient portfolio construction approach to a managed futures strategy, emphasizing low costs with fewer moving parts, is much more effective than high costs paired with complexity. Since inception, DBMF has delivered the powerful diversifying benefits of the managed futures asset class with meaningful relative and absolute outperformance against competitors and its benchmark index. You can see that in this slide showing the historical alpha generation of DBMF versus the Morningstar category, as well as against all of the other alternatives categories beyond managed futures as defined by Morningstar. We made a full 5-minute animated video on this topic, which you can find at the DBMF microsite, dbmf.com. Okay, Andrew, all that said, let's get to your update. That's what they're here for. Over to you.
Thank you, Mike. So we're getting dangerously close to year end, and we're going to keep this one pretty short and plan a longer recap in the new year for both current and potential investors. So after a frustrating October, we bounced a bit in November, up 1% and now up around 8% year to date. So last month, we were a bit behind both the SocGen CTA index, here and after the hedge fund index, and the Morningstar US Trend Systematic category, here and after the Morningstar category, but are materially outperforming year to date. So as Mike said, this has been a year when the core drivers of CTA alpha, which we define as medium-ish term trend in major markets, has really worked much better than more complicated strategies. Or as we say on this, sometimes simpler is better, and quite possibly maybe smarter. Now, which brings us to our macro theme. So I think something profound is going on in the US, and I'm calling it the "a greed is good" moment, a term coined in the 1987 movie Wall Street. On the economic front, the Trump administration is appointing economic glassbreakers, billionaire entrepreneurs, venture capitalists, and frackers even, to parachute into dusty government offices. Now, these are guys who are used to doing things fast with 5 people that the government does slowly with 50. So love it or hate it, it feels significant, an attempt to reorder whether economic activity is driven by unfettered, unapologetic capitalism or directed by government regulations and incentive structures. So this is something we're watching closely and we'll be talking a lot about over the coming months. So please stay tuned. Now, this slide shows the year-to-date performance of DBMF versus the hedge fund index in the Morningstar category. I've been calling this the year of the whipsaw, and actually technically it's been 2 straight years of whipsaws. In any event, after a great start to the year, the whole space got caught in these oscillations in market sentiment in non-core markets during the second and early third quarter, and then the violent unwind of Trump trades in late July and early August, then the surprise snapback in the fall. So it's been really interesting talking to CTA managers about this year. So, shorter term models and sexy non-core markets are supposed to be more immune to these kinds of moves, but have meaningfully detracted from performance. So we'll dive a bit deeper into this in the new year once all the dust has settled. Next slide. So to move to inception to date performance, DBMF has outperformed the target hedge funds by nearly half, and more relevant to advisors is more than doubled the performance of the mutual fund ETF peer group. So in that roundtable I mentioned, one of the hedge fund luminaries bizarrely made the bold statement that no ETF will ever outperform CTA hedge funds over time. And we've obviously proven otherwise. And the idea that a client-friendly, accessible CTA ETF can persistently outperform hedge funds is leading to a radical rethinking of how allocators should think about accessing this space. Now, our focus is on wealth managers who build model portfolios, and after 5 years of research, we're ready to talk to model allocators through a soup to nuts model on how to make a successful allocation to the space. Now, the replication-based index that SocGen launched last year is earlier this year is a key component of this. In any event, my holiday project is to clean up our working slides so we can take you through all of this in the new year. Next slide, please. Here's our slide on volatility-adjusted positioning. The red dots are from the end of September, and the green bars are as of the end of November. The broad theme is that by the end of the third quarter, we'd cut back the strong dollar rising rates bet that had contributed to gains early in the year, but had maintained long exposure to equities, which clearly have been trending up. With the revival of the Trump trade, we are once again long the dollar, but now primarily against the euro, which seems sensible given the issues in Europe. and have a modest bet against rising long-term rates. Also, probably reasonable given the budget deficit, threatened tariffs, anti-immigration crusade, return of animal spirits, etc., etc., etc. We continue to be long equities with a bit more of a US focus and are short oil and long gold, which brings us to the next slide. And here is contribution by factor. We're showing Q1 to Q3 in one column and then Q4 through November in the next column. So as you can see, the big winners this year have been gold, the yen, and equities, while the most difficult markets have been treasuries, where the shifts in market sentiment were most pronounced. As expected, given the whipsaws in fixed income, exposure to those trades is much lower than several months ago, so the P&L in that part of that portfolio has stabilized. And with that, I'll pass the baton back to Mike.
Thanks, Andrew. Let's wrap here as we always do with long-term performance comps. Year to date, 2024 through November, DBMF maintains outperformance against its two key secondary benchmarks. At 7.59% since inception, DBMF is ahead of the SocGen CTA index by over 245 basis points annualized and ahead of the Morningstar systematic trend average by over 415 basis points annualized. Outperformance against the AG, the traditional diversifier for the standard 60/40 portfolio, and the primary benchmark by prospectus for DBMF, inclusive of dividends for both it and DBMF, is over 665 basis points annualized. All supporting our argument, we believe, is compelling in twofold. Managed futures is the most potent alternative asset class and should be considered for every portfolio, particularly in the alts allocation, and DBMF is the most efficient institutional-grade managed futures strategy. So in closing, thanks as always to our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.